Hello guys and welcome back to another video. Now, as you will have seen, Alibaba released their earnings yesterday and the stock price fell, and it fell quite hard. So it fell 6% on the day and it's down around 9%, I think, 9.5% on the week. And if we just zoom out a little bit, even more than that, take it from its all-time highs of $317, we're on a 35% dip. So it's down massively. There's a lot of negative sentiment with this stock. So we're going to look through the earnings, see if it warranted a significant drop in its share price, and then I'm going to explain why I'm still scaling in. And I think that Alibaba is a fantastic business, and I see long growth or strong growth in the long term. So let's have a look at the earnings report. So before we sort of dip into the earnings report, actually, we'll look at a Seeking Alpha report just to give us an overview of why the stock dipped. So this article summarizes the results of the earnings report, and we can see that Alibaba actually beat revenue estimates with 64% year-over-year growth, which is just unbelievable for a company of Alibaba's size. But they did miss out on earnings estimates, and we'll get into that in a little bit. But also, very importantly, their cloud revenue was lower than estimates as well. And a lot of people see Alibaba moving into the cloud space as one way in which they're going to massively increase their profitability. So if they're not hitting the numbers on their cloud division, then a lot of investors are not going to take too well to that. So that is part of the reason as to why we see this dip in the share price. Okay, so just flicking into the earnings report, if we just scroll down, we can see here there's a few statistics on effectively number of users, and just to show you the scale of the business. So Alibaba ecosystem has gross merchandise value of $1.2 trillion. Now this is absolutely unbelievable. So all that sort of tells us is that the value of products which are sold through Alibaba equals $1.2 trillion per year, or it did in the year just gone. And to give you some perspective on that, I've had a look at what Amazon's gross merchandise value is, and it's $490 billion. So Alibaba is selling twice as much in terms of gross value on their platforms than Amazon. And when we think about how large Amazon is, that is quite staggering. So I think that that's good. That's great news. It goes to show you the size of the business. I mean, we know that anyway, but it sort of emphasizes that point. And then we look at the annual active consumers, more than 1 billion global annual active consumers, which is amazing as well. And actually, I listened to the earnings call, and on that earnings call, management were saying that effectively, look, there are around 1.4 billion people in China, and we're already capturing most of them, 65% of them every year. But where we really see the growth is turning those annual active users or consumers into monthly active consumers, and then the monthly users and consumers into daily users and consumers. So they really see their growth in customers returning regularly. And I think that I can see where they're coming from with that. And then this page of the earnings report just gives us a little bit of detail on their new retail strategy, which is to develop a digital commerce infrastructure that offers an upgraded consumer experience by seamlessly integrating online and offline. And we can see here that they offer options such as an on-demand delivery within 30 minutes or an hour. And Amazon offers something very similar to that. And we know how successful that has been in the US. And I think Alibaba are trying to replicate that within their sort of commerce division. Then this page of the earnings report goes on to talk about the cloud business, and it reads here: the post-pandemic world is facing a massive opportunity for industrial digitization. Cloud infrastructure will eventually replace IT infrastructure, empowering enterprises to achieve digital transformation. And I think the general consensus is for Alibaba to really grow into what it could be, into its potential, it really needs to conquer the cloud space. And so Alibaba Cloud needs to outperform. And I'll come on to why that is so important and why investors didn't like what we saw in the earnings report, because we'll see later on that their cloud business did not perform as well as it should have done. But before we get into that, we'll look at the numbers that Alibaba put in both for the quarter gone and for the entire year. So for the quarter just gone, they earned revenues of 187 billion RMB, and that's a 64% year-over-year increase, which is just absolutely phenomenal. And for the year ended 31st March, they earned 717 billion RMB, which was a 41% year-over-year increase. In terms of the conversion from RMB to US dollars, multiplied by 0.15, and you're round about there. So the first thing that I note here is that, okay, 64% year over year increase for the quarter just gone, compared with a 41% increase for the entire year. That suggests that revenue growth is increasing, accelerating, and that's fantastic to see. So in terms of what that revenue is in US dollars, if we just put up a calculator here, so we've got 717 billion RMB, multiply that by 0.15, which is the exchange rate, we've got $107.5 billion US dollars in annual revenue, which is phenomenal. So a company that is earning $108 billion in revenue per year and is growing at 41% year over year is absolutely staggering. So that is very good. And it just goes to show you how cheap Alibaba is. So they're earning revenues of $107 billion per year, and they're trading at an enterprise value of $380 billion. So effectively they're trading at what, 3.5 times revenue, which is just crazy for a company that's putting in growth of 40% year over year. It's unbelievable. And I'll also go on to show the free cash flow which they're generating and why that is also suggesting that the company is severely undervalued. So just on that point, Alibaba earned 172 billion RMB for the year just ended. And if we convert that into US dollars, we get pretty much 26 billion US dollars of free cash flow every year, right? So let's have a look at Amazon, and let's have a look at how much Amazon are generating in free cash flows every year. We go down to the year just gone. Amazon are generating $26 billion per year in free cash flow. So Alibaba are generating as much in free cash flow as Amazon, which is amazing in itself. But now let's consider valuation. So Alibaba have an enterprise value of $380 billion, okay? Amazon, on the other hand, have a valuation or an enterprise value of $1.6 trillion. So 4 times more expensive. So you're paying 4 times as much for free cash flows in Amazon as what you are in Alibaba. And I don't get me wrong, I don't think that this isn't a hit against Amazon. I don't think that Amazon is overvalued. I think that Amazon is a fantastic business with lots of room to growth. And they're both growing at very similar levels, 40% year-on-year revenue growth. But Alibaba is just so undervalued if you're looking at those similar metrics. Now, however, I understand that there are other risks that come with buying or investing in a company like Alibaba. So you've got the risks of the Chinese Communist Party, and we'll get onto that in a moment, as they received a record fine in the year just gone relating to some antitrust policies. So there's always that. There is the additional risk of investing in a Chinese company. If you've not watched the China Hustle, which is on Netflix, go and watch that because that is very interesting. But in short, it's a documentary which goes to show how frequent it is for some of these Chinese companies to effectively completely fabricate all of their financial results. So if you haven't watched China Hustle, definitely watch it. It's an eye-opener. So there are additional risks with investing in Alibaba, and that's why it's so much cheaper than, for example, Amazon. It wouldn't be right just to focus on the positives in this earnings report, though. That's not how I like to look at my investments at all. I want to look at both sides of the story. And one reason as to why we saw the large dip is because we look at their EBITDA margin and it fell. So it fell for both the quarter and the entire year. So for 2020, they had an EBITDA margin of 31%. And in 2021, they had a EBITDA margin of 27%. So there's a contraction there on their margins, and that's not what we like to see. We want to see margin expansion, not margin contraction. So that is definitely a negative, and it's not one that we like to see. And I think it's largely driven by their acquisition in Sun Art, or a stake in Sun Art, which is a traditional brick and mortar grocery store, which typically have lower margins. And so I think that's why we're seeing those low margins. So in that case, Alibaba seem to be focusing on the revenue growth, but they've not taken into consideration, or they've not given much consideration to the contraction in their EBITDA margins as a result of that. And then, of course, another negative is that they actually slumped to a loss in this quarter of 7.5 billion RMB. And I'm sure we're all aware that that is due to the anti-monopoly fine, which they incurred of 18 billion RMB. which is 2.8 billion US dollars. And we can see here an article written by Reuters, which goes on to say that this was a record fine for anti-monopoly violations, and this was levied by the State Administration for Market Regulation. And this was for 4% of Alibaba's 2019 revenues. So this is not profits, that's not 4% of profits, that's 4% of revenues. So this is absolutely huge. And to give you an idea of the scale of this fine, the previous record for the largest fine was a fine which was levied to Qualcomm, and that was for just under $1 billion, and this fine is for $2.7 billion. So it is absolutely huge. And this news came out a little while ago, so that's not why the share price tanked on the latest earnings report. But it just goes to show you again the sort of risks which come with owning a company like Alibaba. This segment of the earnings report just goes to show you how large the business is. So they've got all of these different divisions that they're working in, and then within each of those divisions, they have each of their individual businesses. So they are absolutely massive, which is why they're often compared to Amazon, even though actually their core commerce businesses are very different. So in actual fact, Alibaba's commerce business is a lot more like eBay than Amazon. But I think they're compared due to the fact that each of them have many different divisions. And then another thing that I think many others didn't like about this earnings report was the deceleration in their Alibaba cloud business, and also the ambiguity as to why we saw that deceleration in growth. So we can see here that there was an increase in 37% on their Alibaba cloud revenues, which is very, very good, but it's not as high as the previous quarter, which was 50%, and that was less than the quarter before that, which I think was 60%. So revenue growth in Alibaba cloud is decelerating, which is not good. In terms of why that was, they note here that the slower revenue growth during the quarter was primarily due to revenue decline from a top cloud customer in the internet industry. This customer, which has a sizable presence outside of China that used our overseas cloud services in the past, has decided to terminate the relationship with respect to their international business due to non-product related requirements. What does that mean? What does non-product related requirements mean? You could interpret that in many different ways. I've not decided how I interpret that yet, but it's not entirely clear as to why they have, or why this customer has cut ties with Alibaba, and I would have liked some elaboration there. They do, however, go on to say that excluding this customer, Alibaba Cloud's top 10 non-affiliated customers together accounted for no more than 8% of Alibaba Cloud's total revenue. So what they're saying there is that if we exclude this top customer, we do not have a concentrated customer base, which is generally seen as a good thing, because if you do lose a top customer like they have done, you're not going to see a massive decline in their revenues or their revenue growth. So that is a positive. I just don't quite like the way that they've explained why they've lost this top customer. If we then look into the details of the earnings report, we can see that Maggie Wu, the Chief Financial Officer, states that we expect to generate revenue over 930 billion RMB in fiscal year 2022, which is phenomenal. So let's have a look at what that growth actually translates to. So they're expecting 930 billion in 2022. They achieved 717 billion in 2021. So that is the growth. If we want a percentage of that, 29.7% revenue growth year over year. So 30% revenue growth. I'm happy with that. If they can continue to grow at 30% year on year, that is very good. Although with that being said, that is of course lower than the 41% revenue growth that they just put in. That is fine. I'm okay with that. As the business gets larger, it's going to slow down in its growth. It's just inevitable. 30% year over year revenue growth, I will take that all day long in the businesses that I'm investing in. So that is good news for me. So in terms of what 930 billion RMB is in dollars, just for a little bit of perspective, we can translate that. That's $140 billion per year in revenue. Again, I take us back to the enterprise value, 380 billion in enterprise value. So let's take 380 divided by effectively 139.5 billion in revenue. That's a forward sales ratio of 2.7. 2.7. This valuation does not make sense. I'm telling you, for a company that is growing this quickly and has the dominance that Alibaba does have, it does not make sense. It has a lot of risks. It does have a lot of risks. But honestly, in the long term, I think that this only goes one way. I really do. So in terms of the current enterprise value to sales ratio, we've got an enterprise value of $380 billion. And I prefer to use enterprise value because it takes into account cash and debt. And then we've got revenues earned in the year of 107.5 billion US dollars. That gives us an enterprise value to sales ratio of 3.5. So if we compare that to Amazon's enterprise value to sales ratio, so Amazon have an enterprise value of $1.6 trillion. And if we go to see what their revenues were in the last financial year, they earned revenues of 386 billion, so divided by 386. And their enterprise value to sales ratio is 4.2, whereas Alibaba's is 3.5. So it suggests, again, Alibaba is cheaper than Amazon on that metric. Again, it's not a very good comparison if I'm being completely honest, because Alibaba comes with the additional risks of investing in a Chinese company, and also investor sentiment is always going to be worse for Alibaba than it is for Amazon. That's just the way things are. So yeah, I think Alibaba are a fantastic company. They're trading 4 times cheaper than Amazon when you're comparing them on a free cash flow basis, which is incredible. They're trading cheaper than Amazon when you're comparing them on an enterprise value to sales ratio. Fantastic. Yes, there's a lot of short-term noise and there's a lot of doubt, and investor sentiment towards Chinese companies is not great at the moment, but that will pass. This is a long-term hold. And so that's why I'm very bullish on this company, and I think that the growth going forward is going to be fantastic. So that is all for today, guys. I hope you've enjoyed the video, and until next time, thank you.